to another episode of the Investor Guys podcast. How you doing there, Brother Bill?
I am doing excellent, my friend. Good to see you. And
belated Father's Day.
Happy belated Father's Day to you.
And spiffy background there. I really like that. Glad you're using that.
And thank you very much for that, by the way.
No problem. What did you want to discuss today? I know we've been talking about multifamily. We've also been talking about low-income housing, and we've also been talking about Section 8 housing. Let's combine all of those.
I think that's a great idea.
Before and go over the different benefits of buying a multifamily unit. Now, this is going to be a little more advanced than what a entry-level real estate investor is going to do, but we have people from all different levels that watch this show. So we're talking about like a 10-unit plus type of apartment building, multifamily or mixed use. Why don't you kick it off, and I'll fill in here and there, and we'll cover as much as we can in this show.
So one of the great things about multifamily when you're using it for low-income housing is you have the ability at 20% or more of the units being available for low income. So you don't have to make the whole building a Section 8 building. You can, but you don't have to. If you hit 20%, the federal government looks at that and says, hey, this is a Section 8 building as far as taxes go. So not only do you get additional deductions, but you typically get tax credits on top of that. Now, you need to check with your local HUD office to find out because these tax credits are not necessarily across the board. They are very specific, and they are applicable in different areas. And sometimes you'll get credit in one part of town where you want in another part of town. So they are recognized. I know when Trump was in, as president, they did this thing called opportunity zones. So if you think about that, and it was to drive business to specific areas. Well, the federal government does stuff like that on a regular basis to try to drive whatever the needs are to a specific area. And low-income housing is a huge one that they do things like that for. And what they do is the biggest incentive they have is tax credits. Because in giving tax credits, they don't have to go, first of all, they don't have to go through Congress, we're going to give away money. That's not how it's looked at when they do a tax credit program. So they're not having to raise taxes. They're not having to get approval to spend that money. What they're doing is attracting you and I call it monopoly money, because for them, it's all paper. For us, it hits our real pocket checkbook bank account. So 20% or more gets you all the benefits that the government is offering in a particular area that you're in at the time. That's a huge deal.
And something else to consider is it doesn't have to be Section 8. Okay. Low income can literally be people who meet certain income requirements and they're paying their rent. They're just paying a different variable of the rent that you would make available for the other 80% because they meet that low income standards. They're not necessarily using a Section 8 housing voucher. They don't have a Section 8 housing voucher. You just have to be able to show, based upon the income that they provide to you, that they're a low income family, or a low income renter. The other thing that you'll find, depending upon where you are, and it's just, you'll see this a lot of times in big cities where there's a need for low income housing, is the local jurisdiction will give you a break on your property tax if you provide 20% or more, but it's a minimum of 20% or more to low income housing. Again, it doesn't have to be Section 8. Now, what I like is to make that 20% or more Section 8. I love Section 8 housing. And the places where I invest in Section 8 housing, I have these bigger properties where they're essentially all Section 8. If somebody knocks on the door and they say, hey, I want to pay full fare, I'm okay putting that person in, or my property manager is. But essentially, we make all those doors available for Section 8. If they meet a full voucher criteria, we'll put them in. If not, we'll put regular individuals in. Now, one more thing really quick to point out. Just because you make 20% available doesn't mean you have to have 20% in there low income. So let's say you've got let's say you've got a 100-unit building, just so that we can use even math. 20 of those units are available for low-income housing. Now, you filled up your other 80 units, and those 20 units are sitting vacant. You're allowed to go ahead and start putting regular tenants into each one of those units, just as long as you made them available originally. So when that 20% comes available again, it needs to be available to low income, but it doesn't mean you have to put low income in there if you don't have those low income tenants that are coming in, or that qualify for those particular units. So those are things to keep in mind that are very important. A lot of people don't understand. They're like, I don't want to own a building and have a slum. I don't want to own a building and have those types of tenants. It really is not that type of situation. You'd be surprised. There are a lot of high-end properties that actually use this model because they get such significant tax breaks. These higher end models, they're paying way more in taxes because their incomes are higher. By making 20% of the units available to low income, they're getting great tax breaks, and they're getting guaranteed rents in many cases if they're using Section 8. Just wanted to throw that in there really quick before we come up on our break. Anything to add before we hit that break?
No, when we come back from break, what we'll talk about is some of the numbers and how they need to look to make an apartment building work for Section 8. Because what you can find is a lot of times it is easier to make an apartment building fit into Section 8 than it is buying individual units. So we'll talk about that when we get back from break. That'd be the thing. We're actually about 20 seconds away. Wow, how incredible. We're going to be early.
We finished a section short, so that's okay. I can throw something else in. I'm just kidding. We'll pick up when we come back on how it can be more profitable, actually, and easier to see profits from larger properties. We'll be back in a minute.
A lot of real estate training programs claim that they will make you a millionaire, but how many of them will guarantee it? The Millionaire Blueprint comes with a Millionaire Guarantee. I guarantee that if you use the strategies and you use the formulas that you learn in the Millionaire Blueprint, you will be a millionaire. I guarantee that with a double your money back guarantee. Whether you have hundreds of thousands of dollars to invest or absolutely nothing, it doesn't matter. I'm going to show you how to start investing and be a millionaire guaranteed. Now, I can't tell you all about it in this short amount of time, so go to the guaranteedmillionaireblueprint.com. That's the guaranteedmillionaireblueprint.com. Watch the videos there. Read about the guarantee. Read more about what we offer with the Millionaire Blueprint. Get signed up. I'll see you in Palm Beach.
Once a month, with the exception of December, Bill and I go to markets where we have experience and we host a real estate buyers event. These are markets that have great return potential for your real estate portfolio. We're going to show you the properties that we buy. We're going to show you where to buy, where not to buy, the strategies to use to make great income from these properties. We're also going to show you resources and individuals here on the ground that you can use to start building your team so that you can repeat this process over and over. The real estate buyers events are designed to put high-performing properties in your portfolio right away. If you're interested in hearing more about the Real Estate Buyers Event, realestatebuyersevent.com. That's realestatebuyersevent.com. Read more about the events, check out the schedule, and register. We'll see you there. The Investor Guys podcast. This is our second segment. Now, just before we took the break, I gave you a little teaser. When we have these larger buildings, it is easier for us to make profits. First of all, larger buildings have different variables. Okay. We talk about 50% return on investment all the time. When you start getting into a larger property like this, you're talking about larger income variables, return on your investment. When you have 10, 15, 20 units or more, okay, you have less of an issue when you've got one unit sitting vacant. If you've got a duplex and you've got one unit sitting vacant, that's 50% of your income. If you've got a fourplex, that's 25% of your income. If you've got a 20 unit building that's 5%.
5%.
Yeah. Of your income. So there's a lot of variables that kick in when you are talking about these bigger buildings, these bigger properties. I'm going to turn it back over to you because I actually interrupted you on that first segment.
That's all
Throw
right.
in the information.
Absolutely. No problems there.
I know you're on a roll, so I'm more than apologizing. I'm going to hand that roll back over to you.
Well, one of the things that we look at when we start looking at these multifamily buildings, a lot of times when you're out, you're looking at, a lot of people don't like to buy C-grade buildings. C-grade buildings are freaking home runs when you're looking at Section 8. Now, when I say Section 8, I want you to hear low income Section 8. I like focusing on 8 because of the guaranteed income. So when you look at those buildings and you go out and you look at a very small property, 20 units in a multifamily is a very small property. But from a Section 8 standpoint, great building. So now you start looking at what's my cost per door. So when we look in the markets that we like to invest in, the 4 markets that we like to invest in, if you don't, those are other shows. What we're looking at is kind of a max of about 60,000. And it massages a little bit based on the configuration of the property. But when you just look at straight up, 60 is kind of top end. We really like to stay in that 40 to 50 range because it allows the numbers from HUD to work much, much easier to get the type of cash on cash return we're looking for. Remember, we're looking for 50 or better. When I get newbies in, I tell them 40, but we're really looking at 50 or better. And so you start looking at a small apartment building, a 20-unit building, and you're in a C neighborhood. Well, what most of the multifamily people want to teach you is how you upgrade that C building to a B building. And what we want to teach you is how you milk the maximum profit out of that C grade building. And maybe it becomes a B, maybe it doesn't. It doesn't have to for you to get massive profitability out of it and massive cash flow. So when I'm looking at those properties, I'm looking at B's and C's. And what I'm thinking about is what's my cost per door breaking down to? So I want to be back in that same kind of number. I want to be in that 40 to 50 range. And obviously I want to be under that if I can. And I've got more of an opportunity to be able to get under that 40 a door when I'm looking at a multifamily property in a C neighborhood. Because a lot of multifamily people are freaked out about that. What we look at is just here's a home run opportunity when you're looking at Section 8. Now I've got 20 properties, and you're going to have a mix in there. We want that mix to be 2 twos as much as possible and bigger. You're always going to have some 1 bedrooms in there, and you have to figure that in when you're looking at the property, because you're going to get penalized from a cash flow standpoint a little bit on a 1 bedroom. So I'm looking at what's the mix there. And apartment builders get this. They know you got to have some 1s, but they also understand that the attractiveness in moving this building is the unit mix. And the more I have 2 bedrooms and bigger, the more attractive my complex is when I go to sell it, because I'm going to have better numbers. And again, they always throw in some, for the most part, throw in some 1 bedrooms. But as you and I are looking at that for low income in Section 8, we have to calculate those numbers in. Then you want to look at the building as a whole. All right, here's when you look at your cost per door, you're simply taking, here's the purchase price divided by the number of units. That's my cost per door. And you don't really adjust that cost. Oh, this one's a 2, this one's a 3, this one's a 1, based on the cost per door. The cost per door is what it is. What I'm doing is looking at, okay, what can I go in and create rent-wise with HUD? So make sure that you're going to your county site and finding out what the HUD for your local county is, what they're providing. Every HUD has that on their site, what they're paying. It's different all over the country. And so know for your area what they're paying and how does that fit based on my mix of units. And remember, what we're looking for is a great cash on cash return. No, that was, and that's really as you're looking for that great cash on cash return. We're looking for guaranteed income. Everybody wants to have guarantees in life, and you've heard it your whole life. There are no guarantees. The only thing's guaranteed, death and taxes. Well, pretty close to that, death, taxes, and a sub portion of that, Section 8, because the government always puts that out there. They're not going to stop doing that. If you understand anything about the government at all, and whether you agree with what's going on in Washington or not, if you've listened for more than about 9 seconds, you know that I don't. But whatever they're doing, they're not going to lessen the availability for Section 8 around the country because we are underserviced in this part of the market nationwide. It's a great opportunity for you and I. Yeah. And we are up on break, sir.
I want to throw something in here. Actually, my when it rang, it reset that. We aren't just looking at cost per door. We're also looking at income per door, and we're also looking at profit per door. And when we get back, I want to kick off with that because that's an important variable that we need to consider when we are purchasing one of these larger multifamily properties. We'll be back in a minute. My name's Kevin Mills. I have a real estate training program that is so powerful, I will back it up with a double your money back guarantee that it will make you a millionaire. That's right. Double your money back guarantee that you will be a millionaire if you use what you learn in the Millionaire Blueprint. I call it the Guaranteed Millionaire Blueprint, and you can read more about it and watch more videos at guaranteedmillionaireblueprint.com. That's guaranteedmillionaireblueprint.com. Check it out. All the information is there. 11 months out of the year, Bill Barnett and myself do real estate buyers events in great cities like Orlando, Florida. We bring a group of investors to the cities where we have personal experience. We show them what we're buying, what not to buy, the strategies that we're using to get great returns on our real estate investment portfolios in these specific markets. These events are designed to put properties into your portfolio while you are here. To read more about the real estate buyers events, go to realestatebuyersevent.com. That's realestatebuyersevent.com. Our schedule is there. You're going to read more about the event and you can even register. We'll see you at our next event. With our final segment on today's show, which is just flying by the way. Bill's talking about cost per door. Now, the other things that we're going to look at, cost per door is important, but we want to know what our income per door is going to be. And Bill mentioned a mix of units, 1 bedrooms, 2 bedrooms, 3 bedrooms. For most of the areas where I invest in Section 8, my sweet spot is a 2 bedroom. Okay. There are absolutely vouchers that cover 3 bedrooms, 4 bedrooms, even 5 bedrooms. And there are vouchers that cover 1 bedrooms as well. But the majority of the vouchers are for 2 bedrooms. That means I've got more potential to rent those units quicker than say a 1 bedroom or a 3 bedroom or a 4 bedroom. So I'm looking at not only the mix of units in that property. If I'm real heavy on 1 bedrooms, I might look for a different property. If I'm real heavy on 3 bedrooms or 4 bedrooms in those particular units, I might look for a different property. Now, what I want to know is my income per door. Now, just because there are more vouchers that are going to be for a 2 bedroom, I may, in this particular case, be making more money on the 1 bedrooms in this particular unit. So I'm going to want to focus on the 1 bedrooms versus the 2 bedrooms. And these are all things that your property manager should know. These are all things that your property manager should be on top of right away, but have that conversation with him or her when you get started. Know what your value is going to be as far as your income and your profit on each one of these properties so that you're getting into the right property. Don't just say, oh, well, Bill said, a 20-unit building was great and Kevin said a 30-unit building is better, It has to do with your mix. It has to do with your demand in the market that you're going to be in. And it has to do, again, with your profitability for each one of those doors. So Bill's saying, per door, but make sure you know what you're looking at, what's behind that door. Is it a 1-bedroom? Is it a 2-bedroom? Is it a 3-bedroom? And how that's going to equate to your monthly income, your monthly profit, because we have to take our cost out of that gross income in order to get our profit. So the more we have coming in on gross income, the better profit we're going to have, assuming our costs are staying low. And that's a whole nother show for a whole nother day. Let's talk about taxes, because not only are the tax credits coming into play here, okay, we are looking at buildings and properties that we can do depreciable asset value on that are much, much greater effectors of our tax by doing this depreciable asset on every single year. And we can usually get most of what we're going to pull out of these properties, we're going to pull out in the first 10 years. So not only are we profiting from these properties every single month, okay, not only are we also getting tax credits, maybe even discounts on our property tax, depending upon the county that we're in, but we're also being able to write off a certain percentage of the depreciable value of that property. Now, to understand depreciable asset really quick, and I'm going to turn it over to Bill. The real estate, the actual dirt that your property sits on, doesn't depreciate. Okay, it actually appreciates. But the structure that sits on that dirt, it does depreciate, because the lumber gets older, the glass gets older, the metal gets older, everything gets older. So there is a depreciable asset value. There's a formula that you can use for each different area that you're in that will tell you how much that value decreases on that structure every single year. And it's based upon the purchase price of that building. Now, in a previous show, I think it was just last week, we talked about depreciable asset resetting. So in 10 years, I can turn around. This may be a great performing building for me, and I don't want to get rid of it. But in 10 years, I can flip it over to another entity that I have created, reset that depreciable asset value. So I'm starting again at what I just sold that building to myself for, to start depreciating again. And I'm still making the same types of incomes that I made previously, because I still own this property. Nothing has changed except for the name on the title. And now I've reset that depreciable asset clock. So the differences between all of this is we're talking about 3 different types of tax benefits in addition to our income benefits. I see you over there wanting to say something there, Bill.
No, I'm like, amen, amen, and amen. Preach on, brother. Yeah, I mean, it's a huge, huge piece of the pie. So you get that depreciation in 10 years. And you see this a lot. Look, if this is of interest to you, not only do you want to be hooked up with us, but you also want to find out the local apartment owners association. So that's a very different group than going to the local real estate investment club. So when I go over to the Fort Worth Apartment Association, those meetings, that's a very different level of conversation in the meetings than you find. Almost all real estate investment club meetings are kind of geared toward the beginner. When you get into the apartment association, these are pros. And most of these guys and gals have been in the association a long time. They've been in these units a long time. And that's really, for the bulk of them, that's the only thing they do. Now, we teach a little bit of a combo strategy where you can do wholesales and flips to fund being able to buy more Section 8, more low income, more small apartment buildings. But you will just continually grow. You pick out one thing and you focus on it, and you grow and grow and grow. And as you're getting that down pat, down solid, I've got a profitable flip business. I've got a profitable Section 8 business. I've got a profitable, and not just profitable one time. I have an ongoing business here that is up and running very nicely. Now I can look at expanding that a little bit, whether I'm doing more of the same, or I'm venturing out a little bit and I'm trying to add an additional stream of income. But you can easily get to $1 million a year in income with one strategy. Before you start looking at, gee, I want to split my focus a little bit, And that's an important thing for you to remember when you're doing this. Identify with what makes sense for you, what you think you like, focus on it, and set a dollar amount. I would strongly suggest to you that before you, whatever it is you decide, you stick with that till you made $1 million in it, and then don't do away with it and switch lanes. Keep that going and add another lane to your business, another profit stream.
Yeah. And to Bill's point about the Apartment Owners Association, they are often very tapped into local politics. They are very tapped into the local real estate boards and everything else. They absolutely lobby and petition for better standards with that community, with the city councils, with the different county, even with state. And they are also very tapped into the different types of programs that are available. You will hear about programs from the Apartment Owners Association first before you read about it in the news, before you hear about it from somebody else, because that is what they do. So you'll have programs, and it could vary from replacing all of your toilets with free toilets and getting a bonus because it's more water savvy. So I've literally gotten free toilets for huge buildings, free. Even the installation was free. They paid for somebody to come in and put them in, and gotten $500 checks for every single one that we put in. And these are things that we find out through the association. Now, you're not going to necessarily be a part of that if you're investing in outside areas. Like I invest in a lot of outside areas, so does Bill. I can't go to the apartment owners meetings for each one of those places every single month, but my property manager absolutely can, and they should be a part of that system. So make sure when you're interviewing your property managers, they are aware of that. They are part of that. That's just one of the hats that they wear. Anything you want to throw in before we wrap up this amazing show?
I know it's just flew by.
It did.
Look, don't miss out on low income Section 8. Don't miss out on low income Section 8 and small multifamily buildings and small multi-unit buildings. And when we say small, we're talking 50 or under. In the apartment world, that's a small apartment. But you cut your teeth there on that 20 and under. You get that first feeling, you get that first experience there. And then from that, you can start bumping up to larger buildings. And what happens is you grow exponentially as you do that. So great show today, sir. Look forward to our next one. Thank you guys so much for being on with us.
We will see all of you on Thursday. Please keep in touch, and happy investing, everybody. Bill, you have a great week, and I'll talk to you in a day.
I see you.
Take care.
Bye.